The pursuit of wealth is a constant in human history. But the ultimate success in finance is not found in the chaotic pursuit of speculative gains. It is found in pattern recognition. The ability to see where the system is headed before the crowd realizes it is broken. The Great Crash of 1929, the Black Monday of 1987, the global financial crisis of 2008, and the market of 2025, these are not isolated incidents. They are structural echoes of the same mistake, following an identical sequence of debt creation, speculative euphoria, and forced liquidation. This documentary is the definitive analysis of the same trade's pattern before crash, across a century of global finance. We will dissect the 3 immutable strategies that have worked for every successful investor, from Joseph Kennedy to Warren Buffett. These trades are executed every single time because they address the mechanical stages of collapse. You will learn exactly what these 3 trades are, how they have played out across 4 major crashes, and why they're happening right now in 2025. Understanding this pattern gives you a choice. You can ignore it and hold through the crash like most people, losing 30 to 50% or more, or you can recognize where we are in the cycle and position accordingly. The 3 trades have been made, the pattern is repeating, and the crash is coming. Every financial cataclysm is built on a highly predictable setup. This pre-crash syndrome is defined by the confluence of 4 invariant factors: excessive leverage, extreme valuation dislocation, speculative innovation, and investor overconfidence. The 1929 failure mode serves as the archetypal blueprint, establishing behavioral and structural vulnerabilities that are demonstrably present in the 2025 market environment. The first trade pattern is the surrender of skepticism to the psychological delusion that this time is different. This delusion allows valuations to disconnect entirely from long-term economic reality. The CAPE ratio warning. In 2025, the market exhibits a severe historical valuation anomaly. The cyclically adjusted price to earnings, CAPE ratio, sits around 39 to 40, making the market the second most expensive in history, only trailing the 2000 dot-com peak. This extreme reading confirms the existence of the valuation extreme trade pattern, the permanently high plateau fallacy. This trade pattern is always accompanied by a recurring justification. Just as economist Irving Fisher famously proclaimed a permanently high plateau in October 1929, experts today argue that structural changes justify elevated valuations. Financial history demonstrates that relying on this time is different. Fallacy is a structurally dangerous pre-crash trade pattern, the madness of men. The illusion of difference blinds even the most rational minds. Isaac Newton's downfall in the South Sea bubble of 1720, where he lost a fortune, remains the ultimate warning. He admitted he could calculate the motions of heavenly bodies, but not the madness of men. The most rational mind can be blinded by the glow of easy riches. The deployment of excessive leverage is the most significant technical trade pattern defining the pre-crash environment. It acts as the mechanism that converts optimistic speculation into systemic fragility. The crash follows a predictable mechanical sequence: extreme valuations, excessive leverage, a triggering event, forced liquidation, panic. 1929, the margin account archetype. The leveraging mechanism in 1929 was the ubiquitous margin account. Investors purchased equities with borrowed funds, typically putting down only 10%. This ultra-low initial margin requirement created an effective leverage factor of up to 10 to 1, guaranteeing maximum systemic exposure when prices declined. When Black Tuesday hit, margin calls cascaded, forcing liquidation and driving prices down. 2008, complex credit leverage. The 2008 crisis used complex financial instruments like collateralized debt obligations, CDOs, and mortgage-backed securities to obscure massive leverage and risk concentration in housing. The opacity of these instruments hid the true extent of counterparty risk and systemic interconnection. 2085, record high margin debt. The 2025 market exhibits clear evidence of this pattern repeating. FINRA margin statistics report total margin debt at a record $1.18 trillion as of October 2025. This rapidly accumulating extreme level of outstanding debt represents the strongest quantitative evidence for the 1929 pattern repeating today. High, rapidly growing leverage ensures that any shock will find a market poised for volatile unwinding and a cascading forced sell-off. Financial bubbles are invariably built upon structural innovation. These new vehicles facilitate mass speculation while simultaneously obscuring the true extent of leverage and interdependence. 1929, investment trusts. In the 1920s, investment trusts and utility holding companies served as the innovative vehicles that leveraged capital extensively. When bad news arrived regarding utility regulation in October 1929, utility stocks fell dramatically, forcing the highly leveraged margin buyers to sell, thus setting the stage for the wider panic. 2008, complex derivatives. Complex financial instruments like CDOs serve the same purpose, obscuring massive leverage and risk concentration in a specific asset class, housing. 2025, the everything bubble and opacity. The current speculative cycle is focused heavily on technological and growth sectors, notably artificial intelligence. The trade pattern of speculative innovation persists, manifesting today in opaque, non-traditional leveraged instruments such as leveraged exchange-traded funds, complex synthetic options, and the rapid expansion of private credit. The recurring theme is that these vehicles, investment trusts, CDOs, private credit, all share the characteristic of masking the true extent of underlying leverage and interconnection. The crisis of 1929 was converted into the Great Depression by a catastrophic policy failure. The Federal Reserve maintained a tight monetary policy, refusing to act as the lender of last resort, which allowed bank failures and liquidity shortages to destroy confidence in the real economy. The lesson learned. In every crisis following 1929, 1987, 2000, 2008, central banks executed a critical institutional learning maneuver, intervening with massive liquidity injections to stabilize the commercial banking system. This response, while preventing immediate systemic institutional failure, fuels the next bubble by encouraging moral hazard. The policy trade is the certainty that the Fed will bail out the system, but this bailout comes at the cost of currency devaluation and inflation. Trade number one is the cash conversion. This is the earliest signal, the recognition that markets have reached unsustainable valuations and the smart money is exiting. This happens approximately 12 to 18 months before the crash. The fundamental goal of Trade 1 is to preserve capital and ensure the investor is not liquidated in the coming cascade. The insight. Joseph Kennedy, an aggressive stock speculator of the Roaring '20s, converted to cash early in 1929. He understood that when everyone is leveraged and fully invested, there is nobody left to buy. The execution. Kennedy began systematically converting his stock positions to cash in the summer of 1929, months before the peak. He did this steadily to avoid moving the market and getting poor prices. The result. The Dow Jones peaked on September 3rd. The crash began October 24th. While ordinary investors held their stocks and watched their wealth evaporate, Kennedy sat substantially in cash, protected and ready for the next trade. The concern. Paul Tudor Jones ran a successful hedge fund, but by mid-1987 he was deeply concerned about market valuations and the reliance on new algorithmic trading systems, program trading and portfolio insurance, that increased systemic risk. The 1987 crash was largely caused by a technical breakdown driven by these automated selling mechanisms. The execution. Jones began systematically raising cash in the months leading up to October 1987. He recognized the mechanical fragility inherent in the market microstructure. The context. The systematic exit 12 to 18 months before the crash is the repeating pattern. In 2007, smart money quietly began deleveraging and converting positions to cash as housing defaults became visible and derivative risk became unmanageable. The Buffett blueprint 2025. Today, the cash conversion trade is being executed at an institutional scale. Warren Buffett is widely regarded as executing this trade, sitting on approximately $325 billion in cash. This immense liquidity preserved from the market signals that the smart money perceives the risk of holding equities at current valuations, CAPE ratio 3940, as too high. Insider confirmation. The cash conversion trade is further confirmed by massive insider selling, which is reported at levels not seen since the prelude to the 2007-08 crisis. Those with the best internal information see the real financials, the real customer data, and the real problems, and they are converting to cash. The strategic timing of Trade 1 ensures that the investor avoids being caught in stage 5 of the crash sequence, the forced liquidation cascade. Trade number 2 is gold accumulation. This happens during the same 12 to 24-month window as Trade 1. After preserving capital in cash, Trade 1, the investor must protect that cash from inflation and currency devaluation, which is the inevitable central bank response to crisis. Gold is the 5,000-year solution for wealth preservation. The policy recognition. Bernard Baruch, a successful investor who timed the 1929 exit, converted substantial positions not just to cash, but to physical gold. The policy foresight. Baruch understood that the coming crash would lead to deflation initially, but eventual currency manipulation and inflation later. Gold would preserve purchasing power. The end of discipline. Since 1971, when the United States abandoned the gold standard, the Federal Reserve has operated without the discipline imposed by metal. This means that today, when a financial crisis hits, the Fed can and will execute unlimited money printing, QE, to bail out the system. This policy choice inevitably devalues the dollar, which is why Trade 2 is essential. Financial repression. The systematic policy of keeping interest rates below inflation is known as financial repression. This system quietly erodes the debt burden of the government, the biggest debtor, but destroys the purchasing power of savers. Gold provides a hedge against this stealth confiscation. Accumulation at scale. Trade 2 is highly active and being executed at scale right now. Central banks globally are executing the flight to scarcity trade. China, Russia, India, Turkey, and Poland have purchased over 3,000 tons of gold between 2022 and 2024. This accumulation signals that the world's most powerful financial actors are hedging against the fragility of their own fiat currencies and the US dollar. Investor positioning. Prominent investors confirm this trade. Ray Dalio recommends a significant gold allocation, and Paul Tudor Jones and Stanley Druckenmiller openly hold gold as an inflation hedge. The predicted surge. When the crash comes and the Fed is forced to print trillions to bail out the private credit markets and the banking system, the dollar will devalue 20 to 30%. Gold is projected to surge to $5,000, $6,000, or even $10,000 per ounce, preserving purchasing power while dollar-denominated assets get destroyed by policy. The goal of Trade 2 is to preserve wealth from the policy response to the inevitable collapse. Trade number 3 is the volatility bet. This is the ultimate profit trade, designed to make the investor rich from the collapse itself. This happens 6 to 12 months before the crash. It requires instruments that pay off massively when markets crash, such as short positions, put options, or credit default swaps, CDS. The instrument. After Kennedy exited to cash, Trade 1, the next step was to profit from the inevitable decline using shorting stocks. The mechanism. Kennedy borrowed shares, sold them at euphoric prices throughout late summer and early fall 1929, and paid borrowing costs while waiting for the turn. The payoff. When the crash came in October, stocks fell 30% in days. Kennedy covered his shorts, buying back shares at collapsed prices, yielding estimated profits of $15 million to $50 million, equivalent to hundreds of millions today. The strategy. Paul Tudor Jones's execution of Trade 3 was legendary. After raising cash and hedging with gold, Jones bought massive positions and put options on stock index futures. Put options give the right to sell at a predetermined price. The execution. Jones placed a massive bet that the market would fall far and fast. When the Dow fell 22.6% on Black Monday, October 19th, 96, the largest single-day percentage decline in history, Jones's put options exploded in value, yielding a $100 million profit in that single day. The pattern was identical to Kennedy's. Pay premium while waiting, collect massive profits when volatility spikes. The instrument. Michael Burry, John Paulson, and others utilized credit default swaps, CDS, to bet against the toxic mortgage-backed securities, MBS, and CDOs. A CDS functions as insurance against the default of the underlying asset, the insight. They paid regular premiums for this insurance, betting that the housing bubble, disguised by the complexity of the derivatives, would fail. The payoff. As subprime mortgages defaulted and the CDOs collapsed, their CDS contracts paid out billions, ensuring they profited from the collapse of the financial system. Active hedging. Trade 3 is being actively established right now. Institutional investors are purchasing put options, and the market for volatility instruments is spiking. Commercial real estate, CRE bet. Spiking CDS prices on commercial real estate are a key signal. This indicates institutions are actively betting on a default wave in the CRE sector, which is highly leveraged and faces a refinancing cliff. Public signals. Investors like Bill Ackman have publicly signaled their consideration of hedges similar to his March 2020 trade, which yielded $2.6 billion in weeks. The volatility bet ensures that the profit mechanism is in place when the inevitable forced liquidation occurs. Trade 3 ensures that you profit from the crash itself, transforming a systemic crisis into a massive wealth generation event. The 3 trades work every time because they address every phase of the predictable collapse sequence. Crashes are not random events. They are the consequence of a highly leveraged system hitting an inevitable trigger. Every major crash follows this sequence. Stage 1. The bubble. Extreme valuation. Valuations reach unsustainable levels, fueled by cheap credit and the psychological delusion that this time is different. Stage 2. Excessive leverage. This is the mechanical prerequisite. Margin debt in 2025 is at a record high of over $1.18 trillion, ensuring maximum systemic fragility. Leverage magnifies optimism into fragility. Stage 3, the trigger. Something causes a small decline. The specific trigger doesn't matter. In 1929, it was a combination of a Fed rate hike and news about utility regulation. In 2008, it was subprime defaults and interbank freezing. In 2025, it could be commercial real estate defaults, a geopolitical shock, or a major tech company collapse. Stage 4, forced liquidation. This is the critical mechanical phase. When the trigger hits, leveraged investors face losses, triggering margin calls. They are forced to sell, driving prices lower, which triggers more margin calls and more forced selling. This creates a cascade or death spiral where selling begets selling. Prices fall not because of fundamentals, but because of mechanical necessity. Stage 5, panic and liquidity disappearance. Fear takes over. Everyone sells, regardless of what they own. Liquidity disappears as market makers pull back and prices gap down violently. The VIX spikes. Stage 6, the policy response. The Federal Reserve intervenes as the lender of last resort, injecting massive liquidity, money printing, to stabilize the system, resulting in long-term inflation. When stage 4 hits, the three trades pay off. Trade 1, cash. The investor is not exposed to the forced liquidation cascade and has preserved capital. Trade 2, gold. The investor holds an asset that appreciates or maintains value during the inevitable currency devaluation of stage 6. Trade 3, volatility. The instruments purchased, puts, CDS, VIX calls, explode in value during the panic of stage 5, generating immense profit. The three trades address every phase of the crash sequence, which is why they work every single time. After the three trades pay off, there is an implicit fourth trade that creates generational wealth. The execution. After capital is preserved, trade 1, wealth is protected. Trade 2, and profits are made. Trade 3, the prepared investor deploys everything at the moment of maximum fear. This is when the S&P is down 50% or more, real estate is being foreclosed, and quality businesses are being liquidated. Historical examples. Joseph Kennedy executed this after the 1929 crash, buying businesses and real estate cheap. Warren Buffett did this in 2008, investing $5 billion in Goldman Sachs at the absolute bottom. Bill Ackman used his $2.6 billion payout from his March 2020 hedge to buy stocks at crashed prices. Psychological fortitude. This is the hardest part. It requires having the courage to buy aggressively when every headline predicts the end of capitalism and when fear is maximum. That psychological fortitude separates the investors who get rich from crashes from the investors who lose everything. Every crisis is fundamentally a transfer of wealth. Crashes do not destroy wealth. They redistribute ownership. The middle class. Loss. The middle class is always destroyed first, not because they are evil, but because they are fully invested and fully leveraged, relying on the illusion of stability. They are caught in the liquidation cascade. They are taught to trust the system, and that ignorance is the most powerful trick of all. The policy theft. The middle class is destroyed by the government's quiet theft. Financial repression, keeping interest rates below inflation, erodes the purchasing power of savings, punishing prudence, and pushing citizens to become forced speculators. The cost of bailouts and systemic failure is always transferred upward. The consolidation of power, the prepared elite, holding liquidity and knowledge, buy the distressed assets at fire sale prices. The system survives by sacrificing the financially uneducated to protect the institutions. The recovery that follows is created on their terms, leading to concentrated ownership and generational wealth. The collapse pattern from 1929 to 2025 is not a coincidence. It is the application of ancient immutable laws of money and power. These three laws, identified centuries ago, define how wealth concentrates and how money loses value. Gresham's law, the law of quality. Bad money drives out good money. When rulers, or central banks, debase the currency by mixing copper into silver, Rome, or printing cheap credit, 2025, people notice. They hoard the pure, scarce assets, gold, silver, real estate, and spend the depreciating bad money. Today, cheap credit and easy debt drive out savings, discipline, and patience. Cantillon effect, the law of proximity. Money is never neutral. When new currency or credit enters the economy from central bank at QE, it flows through bond markets, banks, and asset prices first. Those closest to the money printer always win. By the time the money trickles down to the ordinary citizen through wages, prices have already risen and the value has been diluted. Pareto principle, the law of concentration. Wealth concentrates. This principle explains why inequality expands with credit expansion and why a minority will always control the majority of value. The system is mathematically designed for concentration. The system today is caught in the debt trap. Governments borrow to pay old debt, and central banks are forced to execute financial repression, trade two's cause to survive. The policy trap. When the next crash comes, policymakers are nearly out of ammunition. They cannot cut rates dramatically because inflation remains a threat. They cannot print money indefinitely without risking hyperinflation, the Weimar pattern. The policy certainty. However, the central bank will still choose to stabilize the system. This means the inevitable response will be massive liquidity, followed by high, persistent inflation. Confirming trade 2 and trade 3 will pay off handsomely. The financial architecture of collapse is repeating with structural precision. The psychological delusion, and the leverage buildup, record margin debt, and the institutional exit, Buffett's cash, central bank gold buying, are all in place. The three trades are active. The defense. Financial freedom depends on vigilance, not luck. You must stop treating speculation as growth and stop confusing paper promises with real value. The personal fortress. Build resilience by reducing debt, holding real, scarce assets, gold, productive assets, and maintaining liquidity. Trade 1, the final warning. The system is designed to protect itself, not you. The crash is coming. The question is whether you will be the victim of the next collapse, the fuel for the liquidation cascade, or the survivor who used knowledge as a shield and bought at the bottom. The trades must be made before the crash.